we're joined by Paul Kennedy, Head of Tax and Estate Planning at Fidelity International. Thanks so much for coming in to speak to us. So first of all, just take us through the implications of the 50% tax rate.
Well, first of all, I should say Happy New Year to everybody. It is, of course, the first day of the new tax year, and this is why we're talking about these taxes. I'm not certain it's going to be happy. What we're seeing for the first time in a number of years now is the introduction of new higher rates of income tax. There's two of them, really. The first one is very easy to explain. For anybody with income above 150,000, the rate of tax goes up from 40 to 50%. But there is actually a second increase as well, and this is going to apply to anybody that earns more than £100,000. And there's a little bit of a stealth manoeuvre going on, because what's going to happen is people's personal allowance is going to be reduced by £1 for every £2 you earn over £100,000. So actually, for people that earn over £100,000 up to £113,000, their rate of income tax is going to be 60%, slightly higher than those 50%. So two new tax bands coming in to supersede the 40% rate we have at the moment.
Okay, so what are people doing then to protect themselves from the new tax rate, or at least limit its impact on their earnings?
Difficult sometimes with earnings, because if you're employed and you're receiving income, then there's very little you can do. I think one thing that people can look at is their investments, because you have to remember that it is your investment income that's going to be hit at these higher rates of tax. Actually, some people do face the spectre now in terms of their investments of having to give more that they make from their investments to the government than they keep themselves. And there are things that people can do in terms of their investments, but I think quite limited in terms of what you can do in terms of your earnings.
And what do you make of the critics and what they've been saying that the tax risks driving bankers away from London to rival financial centres?
We're seeing an increase of 10p in the pound, and we know not how long that increase is going to last. I think it's probably difficult to say that people are likely to up sticks and leave the country solely because of the 10p in the pound.
You don't think it'll make London a less attractive place to do business?
It's going to make it marginally less attractive, but whether it is big enough and deep enough to write London off as a centre, I very much doubt it in the short term.
Paul Kennedy, thanks very much for your thoughts, your analysis on that. Appreciate it.